Methods to finance investment real estate. Investing in real estate can be a profitable endeavor, but financing these investments often requires careful consideration. Here are 5 common methods to finance investment real estate, each with its advantages and disadvantages. Conventional mortgage loans are a popular choice for financing investment properties. These loans are provided by banks, credit unions, or other financial institutions, and often require a 20 to 30% down payment. Low interest rates. Conventional loans typically offer lower interest rates compared to alternative financing options. Predictable terms. Fixed-rate mortgages ensure consistent monthly payments, aiding in financial planning. Wide availability. These loans are widely offered by various financial institutions, making them accessible to many investors. High down payment. The significant upfront cost may be a barrier for some investors. Stringent credit requirements. Borrowers must have a good credit score and strong financial history. Limited to a certain number of properties. Most lenders cap the number of properties that can be financed through conventional loans. Hard money loans are short-term loans provided by private lenders, often used by investors who need quick access to funds or cannot qualify for conventional loans. Quick approval process. These loans can often be approved within days, enabling investors to act swiftly in competitive markets. Less stringent requirements. Hard money lenders focus more on the property's value than the borrower's creditworthiness. Flexible terms. Lenders may tailor loan terms to fit the investor's specific needs. High interest rates and fees. These loans come with significantly higher costs compared to traditional financing. Short repayment period. Terms usually range from 6 months to 3 years, which may not be ideal for long-term investments. Risk of foreclosure. Failure to repay the loan within the short term can lead to property loss. The Federal Housing Administration, FHA, offers loans designed primarily for first-time homebuyers, but can be used for investment properties if the borrower resides in one unit of a multi-family property. Low down payment. FHA loans require as little as 3.5% down, making them accessible to more investors. Flexible credit requirements. These loans are more forgiving of lower credit scores. Government-backed. This reduces the risk for lenders, potentially leading to easier approval. Occupancy requirement. Borrowers must live in one unit of the property for at least a year. Mortgage insurance premiums. Borrowers must pay an upfront and annual premium, which adds to the overall cost. Loan limits. FHA loans have borrowing limits that may not cover high-value properties. Private money loans are funds borrowed from individual investors or private entities, often based on personal relationships or business connections. Flexible terms. Terms can be negotiated between the borrower and lender, offering more customization. Fast funding. These loans often close quickly compared to traditional financing. Accessible to investors with poor credit. Approval depends more on the relationship and trust between parties. Higher interest rates. Private money loans are generally more expensive than traditional loans. Risk of damaging personal relationships. If the investment fails, it could strain relationships with the lender. Less regulation. While this can offer flexibility, it may also lead to unfavorable terms or disputes. Real estate partnerships involve pooling resources with other investors to purchase and manage investment properties. Shared financial burden. Costs, risks, and responsibilities are divided among partners. Access to larger investments. Partnerships can enable the purchase of higher-value properties. Skill sharing. Partners can contribute complementary skills, such as market knowledge or property management expertise. Potential for conflict. Differences in goals or management styles can lead to disputes. Profit sharing. Returns must be divided among partners, reducing individual earnings. Complex agreements. Legal and financial arrangements can be intricate and require detailed contracts. Choosing the right financing method depends on your financial situation, investment goals, and risk tolerance. Conventional loans offer stability and low costs, but demand excellent credit and significant upfront capital. Hard money loans provide speed and flexibility, but at a high cost. FHA loans make multifamily investments accessible to first-time buyers, but come with residency requirements. Private money loans can be a flexible option for those with personal connections, but may strain relationships if the investment underperforms. Finally, real estate partnerships allow resource pooling, but require strong collaboration and clear agreements. By understanding these options and their implications, investors can make informed decisions and optimize their real estate portfolios. Contact the Scott Bechtel Group today to discuss the best option for you.